All right, Joe Saglimbeni back on his YouTube channel, Joe Saglimbeni. How you guys doing? Another Saturday edition of Let's Chat Live, and this time we're going to talk about building a great stock portfolio. And let's put this in here. See that? Show. Just screwing with my all right. Okay, we're back. All right, so guys, if you can hear me, let me know. Give me a like or a thumbs up out there. Hopefully, I am doing a good stream. As a matter of fact, while I'm here, I'm going to test the stream like I always do and see if I am getting a good speed here. 1 second. Would have been nice if I would have done this before I came in here. No, it looks good. Okay. All right, guys. So, little introduction. Joe Saglimbeni, blue collar worker, been investing in the stock market for over 3 decades. This is my YouTube channel. Every Saturday, I try to do a live stream called Let's Chat Live, and I try to do a subject that I'm interested in, or maybe the audience gives me a suggestion on my community tab page on my YouTube channel. So today, I wanted to talk about creating a great stock portfolio. Specifically, how I did it over the years, how I learned to do it, and whether or not it would be good for you is up to you, obviously. So before we start, I just want to say to put this disclaimer out there that I am not a stock market, money market financial planner, stock pro, financial planner, stock expert, money expert. I don't even play one on YouTube. This is all my personal opinion on the way I invest. So please do your due diligence. Reach out to a financial planner or investment professional, because these are assets that may be risky or may not be risky, and you have to do a lot of studying and make sure you get it right. All right. So, with that being said, let's talk about how I create a good stock portfolio. Basically, I think of, and just let me explain that I'm not going to be talking about mutual funds here, though you can build a portfolio with mutual funds, but I'm talking about individual stocks and building a portfolio from individual stock companies. And that's what I'm really talking about here. So mutual funds we will not talk about. We are talking about individual securities, stocks of companies. So I learned a long time ago to build a portfolio of a basket of stocks, maybe 20 stocks, 25 stocks. And some people may say that when you build a portfolio of that many stocks, that you're really building an index. And this is not true at all. A major index like something like the S&P 500, which you can compare your portfolio to, consists of over 500 stocks in mostly blue chip companies which work across the globe, really. These are the bluest of the blue chips, the Johnson and Johnsons, the Coca-Colas, the McDonald's, the Home Depots, the the bluest of the blue chips. So you will have some of those blue chips in your portfolio, or I do have some blue chips in my portfolio that are part of the S&P 500. But my goal is to create a diversified basket of stocks, and my goal is to beat the S&P 500 consistently. So I have done that, and I'll leave a video of the my performance against the S&P 500 right here. I'll leave it either up here or down in the links below. But the point is, that's my goal. Over time, the S&P has done maybe 12 to 14% in the last, let's say, decade. And maybe the last 100 years, it's done, 9 to 12%, something like that. Let's just say over 10% or around 10%. So your goal should be to beat that 10%. Now, how are you going to do that? You're going to build a basket, a portfolio of great companies and great stocks. So, stocks that are part of, or shall we say, companies that have great stock performance with their stocks. And this is the difficult part, is finding those stocks and then building the portfolio. So a couple of weeks back, I did a live stream on It Starts with the Charts. And the reason why I did that is because that's how you would start to find these stocks. So let's assume we found some stocks. How do I create my portfolio? And what do I mean by a diverse portfolio? So I'm going to give you some examples. And some of these companies I own and some I don't. But I'm going to throw some major companies out there, big blue chips, and tell you how I look at a portfolio. So let me start by saying I look at a portfolio like a strip mall. And what I mean by that is, in a strip mall, you have anchor stores. You may have a Macy's, and you may have a Home Depot, and you may have a Costco, and you may have a movie theater. You have these anchors in this mall that people flock to go see, to go to the mall. So there's a lot of foot traffic because of these anchor stores. Well, your goal when you're creating a stock portfolio, actually my goal when I was creating a stock portfolio, is to make all the stores anchor stores. So in other words, all the stocks should be anchor. Now you're thinking to yourself, that's kind of crazy. How are you going to do that? Well, you take industries that have equities or companies that seem to grow, and out of those industries, you pick the best stocks. After doing a deep analysis, you pick the best stocks and you start creating a portfolio. And these stocks are really anchor stores or anchor stocks. And all of a sudden, you have 20 or so unbelievable companies that will most likely do better than the S&P 500, which let's say is 10%. So these individual securities need to do better than the S&P 500. And that's what you're looking for. That's the goal. So here is an example. I'll throw an example of what I mean to going against the S&P 500. So I'm going to share a screenshot of Nike. So full disclosure here, Nike I do own in one of my portfolios. And here's the thing about Nike. So right here, we have Nike, which did 249% for a 5-year period against the S&P 500, which did 116%. Now, understand that does not show dividends reinvested. Both the S&P and the Nike, both Nike and the S&P, would perform better when you add in their dividends reinvested. But just for simplicity, we're just going to show a chart. So for 5 years, Nike beat the S&P 500. And if we go, let me see if I can change this here. I think I can. Let's go and change this to expand it a little bit. All right, let's go. Let's expand it a little bit longer. And you're going to see over that time, and let me take the dividends out of here. My events, dividends. And you're going to see that since around 2000, Nike has outperformed 2,500% to the S&P's 221%. So that is the goal. Right there is an example of an anchor type stock. That's an example of a stock that you can now put in the portfolio. And that is in my portfolio. So after an analysis, I put Nike into one of my portfolios that I'm building. That's an anchor stock. That's a stock that has a brand, a moat, earnings that are growing, dividends that are increasing year over year, and most importantly, it beats the S&P 500 consistently. So right now, I just gave you a stock. Now, not a financial advice, not financial advice. This is an opinion of mine that this is one of the great companies in America and one of the great stocks in America. So you could create and start like that, building your portfolio. So, what kind of industry is Nike? Well, Nike's probably like apparel consumer. Now, apparel is kind of a weak industry, and you'll get to know this when it comes to stocks. It's like a weak industry, and you'll get to notice as you become a better analyst of stocks. But Nike's not really just apparel. It's a brand. It's a consumer product. It's one of the most famous. Hey, Tectonic, how you doing, my friend? Give me a thumbs up. And can you hear me? Can you hear me, Tectonic? It's not just a stock. I mean, just an apparel. It's a brand with a major moat and one of the top brands in the world. And as you can see, it performs that way. So basically, that would be one of the stocks you would put into your portfolio. Doing all right. Yes, thank you, Tectonic. Good to hear from you. And that's one of the stocks you would put in your portfolio. So that's what you have to do. The whole idea is to find equities that can beat the index. And don't listen to people that will say to you, well, aren't you really just building an index with 20 or 25 stocks? Absolutely not. And I'm going to give you an example. I am going to, again, go to the chart and show you what I mean by putting in a couple of more stocks that I think are great. So I'm going to add here another company which I consider a great brand, and the competition is very minimal, meaning there's not many players playing in this game. So one of them would be Lowe's. Lowe's Company. That's the home improvement giant. And right away, when you see and I put it in there, you're looking at a 1,500% return over the S&P 500. And if we go back to 5 years, you'll see it's done almost exactly what Nike has done. So there you go. That is that another stock that you could now put in your portfolio as you're building it. So you say, okay, Joe, is there another stock? Well, as you could see, you're noticing, and let me get off this screen and come back here. What you may be noticing is Lowe's, Nike are brand names with not much competition. You would think that Nike in the apparel business has competition, but it really doesn't. It's not only an apparel company, it's a supporter of sports. It's a consumer good. It's a brand like no other apparel in the world. And that in and of itself makes it a great company and continued growing of earnings, dividends, and EPS every year. All right. Lowe's, very similar. Not many home improvement stores. Home Depot, Lowe's. Small companies, I can't even recall right now some of the small companies that compete with Lowe's and Home Depot. I happen to like Lowe's, but Home Depot is just as competitive and it is good. Again, you got to do your own homework here, not financial advice. Go out and do the homework. Build this portfolio. And now you just got to find. So I gave you two stocks that I like. Doesn't mean they're going to go down or up or whatever. It's what I have in my portfolio and what I think are good companies. And after deep analysis, I feel they are great investments. So I'll give you one more. Okay, let me show the chart again. Get back here to Yahoo. And this is another company, and this is a company that I'm going to give you that does have a good amount of competition. I currently don't uh, own this company, but I used to own it, and that would be PepsiCo. So you're going to see here, PepsiCo has lagged the S&P 500. But if we expand this out a little bit, you'll see that Pepsi starts achieving at least on par with the S&P 500. Now you're going to say, wait a minute, Joe, why is this a good company? Well, this chart on Yahoo's not showing dividends reinvested. So I'm going to go and show you now a how Pepsi has done. And this is buyupside.com. It's one of the websites I use. I want to thank buyupside.com for the information here. I put Pepsi into this and I will put about 10 years and I will calculate returns. And what you will see here is you will see that Pepsi had an annualized return of almost 13% and a total return of 238% over that. Oh, actually, none of you guys saw that because I didn't share it. Let me share it. All right. Let's hide the Yahoo chart. Okay, so what I did here is I put Pepsi into buyupside.com, and you're going to see that it did a 12.95% return annualized and a total return of 238%. And if you look at the chart for on Yahoo, you're going to see that in the 10-year period, roughly the 10-year period, that the S&P did around 430. Let me try to get it exact here. I want to get this exact because I want to compare it exactly. So let's go here on the Yahoo chart, and we're going to go back to 2011, November, and we're going to apply. And you're going to see that the S&P did 272%, and that Pepsi did 154, but with dividend reinvested. And we'll show that. Pepsi did 238%, losing out to the S&P 500. And now maybe that's the reason why many years ago I got rid of Pepsi, because it did not perform well against the S&P 500. Now, you can replace Pepsi, which I think I replaced Pepsi with Starbucks. And let's see how Starbucks has done with on the chart for Yahoo, from Yahoo. Let me go there and put in Starbucks. And I may not even, they also pay a dividend, but I may not even have to put an example of a dividend with Starbucks, because I know that it has outperformed the S&P 500. This is Starbucks. This is the S&P 500. This is about 10 years. And if we go 5 years, right there, it's about the same as the S&P 500, but it pays a dividend, and it definitely beat the S&P 500 when you add in the dividends. And though you can't see it, actually what I'm going to do here is share it. So you saw the Yahoo chart, but I'm going to hide that and bring in my buyupside.com website, and we're going to put in Starbucks, and we're going to do a 5-year period, which would be, I guess, 2016, and calculate returns. And you're going to see that, yes, it did 16% a year, 112.31%, and you should be seeing that on the screen there. And so remember that 112.31. Show this here and see if it did. Wow, it's still losing to the S&P 500, but still, over a 10-year period, it has blown us away. And I know that the pandemic has been tough on Starbucks, but what I'm trying to say here is that that's how you build a great portfolio. Some of the stocks are not going to perform beating the S&P 500 over a certain amount of time. Maybe it takes 6 years, 5 years, 10 years, but you build it, and if you build it well, you will beat on average the S&P 500, and that is the ultimate goal, and that's how you create a great stock portfolio. All right, guys. Wow, this was a long stream because I had to add all in that stuff, but I just want to say again that I want to thank you guys, of course, coming to the channel. I'm Joe Saglimbeni, and if you like this, comment, share, subscribe, let that algorithm work for me. Hopefully you enjoyed this very long stream. Usually I don't go this long, but I want to thank you all, and I'm going to say goodbye. Go out and build that great stock portfolio, and I will see you